So today on our Labor Day weekend show here on Dollars and Cents, we're going to talk about a topic that confuses many, the required minimum distribution, affectionately known as RMDs. We're going to talk about the issues and the confusion that surrounds these required distributions from your retirement accounts. We're going to give you some background information, explain how they're calculated, when and who must take them, and how the rules have changed over the years. Because we hear these conversations on a regular basis in the office where people still think that the age is, say, 70 and a half, and it's not, and we're going to tell you what it is here later on in the program. And then we're also going to be going over those 5 financial boxes, if you will, that you need to check if you're thinking about retiring early. Now, retiring early, generally viewed as retiring before age 65. These are the things that you want to be asking yourself to make sure that you are in good shape before you hit the exits from your job. Just had this very conversation with a couple of different folks this past week at the office. Good news is that they were able to check all 5 of those boxes. So hopefully, if you're thinking about retiring early, you can check those 5 boxes as well. So welcome into Dollars and Cents, where we help you make sense out of all of life decisions involving your dollars. One of Central Florida's longest running radio programs. Also a top financial planning podcast, courtesy of a variety of lists that the folks at FeedSpot have put on over the years. We keep making those top planning podcasts, top financial podcasts each and every year. Of course, to know how you can connect with us on our podcast platform, well, then you can go to our website at Nelson Financial Planning, look for the icons that'll immediately connect you, or you can go to the platform and look for Dollars and Cents, Nelson Financial Planning, all of that. Probably easier to just go to the website, and then that way you're directly connected to the channel. Once you're there, make sure you hit that subscribe button and smash the like button too if you find a topic that is ultimately of interest to you. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Going solo this week on the program. Normally, it's one of the fellow certified financial fiduciaries at Nelson Financial Planning who join me, but we're going to try and tackle this one over Labor Day weekend just myself. So hopefully we'll do a good job. Of course, that's how I used to do the show way back when we were a much smaller organization. Speaking of the show with fellow certified financial fiduciaries at Nelson Financial Planning, a couple of follow-up items, if you will, from last week. Now, if you missed last week's show, our very own Kristen Costello, who is not just a certified financial fiduciary, she's also a certified financial planner and a CPA, joined us, and we really kind of continued the summer series, if you will, of breaking down different aspects of the One Big Beautiful Bill. If you missed the program, you missed a lot. That's why, you got to go to those podcast platforms to learn more. And if you're interested in kind of figuring out how this bill impacts you, because it had a variety of impact beyond just taxes, so much broader in scope. Of course, 900 pages. And so it took us several episodes over the course of July and August to really kind of break it down or break down the details of what was sort of important to the average person. So make sure you check out that. But anyway, a couple of items to follow up on. The first item was kind of at the end of the show. If you recall, if you're a regular listener, Kristen and I were bantering back and forth on kind of the bonus depreciation provisions of the One Big Beautiful Bill, which, as we said, are already sort of making its way into corporate earnings, most evidently on some of the most recent earnings that were just completed, earnings season just completed here over the course of the past week or so for the second quarter of this year. And so what we were talking about was, it's kind of odd that the ability to take bonus depreciation as a firm on a capital asset that you would have purchased was retroed not to January 1st, like you might kind of think, but in fact January 19th. And so we were saying, well, why that particular date? And so we were kind of bantering back and forth at the end. And the second the show ended, we were like, wait a minute. We know the significance of January 19th. That was Inauguration Day. So I guess if you bought your capital asset when the other guy was in charge, you don't get the bonus depreciation. That's a big question mark in the bill as to how that works. What do we say to that? I guess only in Washington would something like that transpire. Item 2 of follow-up from last week, of course, is our topic this week, going over those 5 financial boxes. We thought we were going to have time last week on the program, but yeah, there was a lot to talk about with those various tax provisions. So we're going to get into that in great detail. Also, we spoke about corporate earnings, banks and financial institutions in particular. Sort of had a good earnings season. I guess you don't have to go very far to figure out why, because the other statistic that floated across my desk just this past week was that the average credit card interest rate for the month of August, okay, is 23.99%. So that's pretty recent data, because here we are as of the live date of the show. It is the last day of August. 23.99 is the average credit card rate. Guess what? If you're getting charged 23.99% on something, it's going to be really hard to kind of get ahead of that and get that paid off and improve your overall financial picture. So bottom line, if that is the case, that's really where you need to focus and put any available extra dollars to help get rid of that, because you're fighting an uphill battle, that is for sure. Well, as we mentioned, it's the last day of August, and as the calendar falls, tomorrow is the first day of September, which happens to be Labor Day. So it is, I guess, a 3-day weekend for most folks. That would put 2/3 of the year 2025 in the rear view mirror. Tomorrow, of course, being Labor Day, federal holiday. Build that into your timing, if you will, because if you get money out of your accounts, like let's say you've got a systematic withdrawal plan because you're retired, taking income off of your investments, and you have that money coming out on the 1st, just be aware that, might take an extra day or so as a result of that being a federal holiday. So just be aware that might be a little bit of a delay on your receipt of that normal income, especially if you've got it dialed in for the 1st of every month. And of course, as we know, Labor Day traditionally marks the end of summer and the beginning of fall. Of course, down here in Florida, it's pretty much summer all the way around. Celebrate on the first Monday of September, a little history, if you will, on Labor Day, done to honor and recognize the American labor movement and the works and contributions of laborers to the development and achievements of the country. Holiday itself originated in the late 19th century as trade union and labor movements grew. Oregon, in fact, was the first state all the way back in 1887 to make it an official public holiday. And then it actually became a federal holiday in 1894. So this one's certainly been along for a while. And hopefully folks are taking that extra day and sort of enjoying the weekend. If you're driving around your neighborhood or maybe doing some projects and having to make a run to the hardware store this weekend, your eyes are not deceiving you if you think you are seeing houses sitting for sale longer in your neighborhood this summer. Here's the latest stat. The typical home sold in July spent an average of 43 days on the market, 8 days longer than a year earlier. That's the longest time on the market for houses sold in July since 2015, so over a decade. Interesting, I guess. Suspect that could be many of the folks out there kind of waiting for the Fed's next move, which we'll probably see in the next 30 days. And obviously, we will be talking about it here on Dollars and Cents. With that, we're going to take our first break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Stay tuned after these messages. We're talking about these sort of issues, or I guess we're describing them as boxes to check, that if you're planning on retiring early, there are 5, probably more than that, but we've got 5 that are very specific boxes that you need to check now to make sure that you're going to be on track for retiring early. As we mentioned earlier in the program, had this conversation with a couple of different folks this past week. One couple, age 59 and 60, looking to retire at 62. Another couple in their mid-50s looking to retire at 60. So that would sort of be your classic definition of retiring early, right? You're planning on retiring early before age 65. So that presents sort of a unique set of circumstances that you really need to kind of work through. And so that's the purpose of this segment, is to kind of help you think about and work through what those issues might be. Because last thing you want to do is give notice, right? Only to find yourself unprepared to succeed in retirement once that final paycheck comes in. That would be the very definition of a problem, because once you leave your job, it's oftentimes hard to come back, and even harder to find a similar job that pays as much as you may have been making. So you don't want to do that. And certainly that's why, speaking of those conversations we have at the office on a regular basis, we typically do those in a series of conversations, not like one conversation and poof, you're retired. It's usually 2, 3, 4 sometimes over the course of time to really make sure that you're on the right track for retirement. And so that is, of course, the primary role that we serve at Nelson Financial Planning. It's helping to kind of work through with people these types of issues. So we're going to share on the program the 5 things, or the 5 boxes that you want to make sure gets checked if you're thinking about retiring early. First and foremost on the list, no surprise, we talk about this a lot on the program, is that you've got to have an understanding and an accounting for what are going to be your health care costs. That doesn't just mean the health insurance, because according to a most recent survey, the average 65-year-old is going to need about $165,000 of after-tax assets. So that's, net, not gross, in savings in order to cover their various healthcare expenses through retirement. So if it's a couple, well, you've got to double that number. So that would be $330,000 of after-tax money to be able to cover that. Healthcare, folks, is perhaps one of the single biggest retirement gap issues that we see for a lot of retirees. And if you're trying to retire early, it's particularly an issue, right? Because you don't get Medicare until age 65. And then, even then, Medicare isn't exactly free. That was one of the parts of the conversation that we had with one of the couples this past week. They're like, I thought Medicare was going to solve all of my problems and not have to worry about cost anymore. And yeah, it doesn't work that way. Because if you got Medicare Part B and then you got a supplement and then you throw in D, it can easily run $800 a month for an individual. So even then, you're figuring, maybe $1,600 or $1,500 a month on just that expense. And then that doesn't cover all the other health-related expenses like dental and vision and things like that. And of course, if you're trying to use COBRA, that only lasts for 18 months, right? And then you have to pay the full premium of that without any kind of employer subsidy. Of course, you've got the marketplace, but the tricky part there is always with the marketplace. We run into this all the time. When you're getting that monthly cost off of the marketplace, off of the exchange, off of Obamacare, whatever you want to call it, that is in fact an advanced tax credit. So all might seem lovely, and you're not having to pay as much on your health insurance as you might think. until you get to April 15th, and then you actually file your tax return, and then you actually report all of your income, and then that number of income then determines whether you get to keep the tax credit that was advanced to you along the way, or you have to repay it. Sometimes you may find out that you are eligible for more, but more often than not, it's people having to pay it. So just be aware of that and how big of an issue that healthcare is. So if you plan on retiring early, the focus really starts with, okay, how do I tackle these healthcare costs? Second is now you're to really start to look more at the finances and kind of what the cash flow, what the income is going to look like, what the expenses are going to look like. I mean, obviously that gets us into the conversation about budgeting, looking at money in, money out. But also you have to take a look at the underlying investment allocation as well, right? If you're really that shift when you retire is a shift from kind of the accumulation phase to the spending phase, from the growth phase to maybe kind of more the income phase. And that really does require you to think about your investment allocation a little bit differently. Hopefully you've been doing that along the way as you're kind of getting closer to retirement, so it's not some, complete pivot, if you will, in terms of your investment allocation. And then lastly, you've got to make sure that as you're taking that income out, that you are ultimately creating the most tax efficient retirement that you can. And of course, that last part is of course where the tax team at Nelson Financial Planning, folks like Kristen Costello, who joined us last week, Christina Lamb, as well as many others that are a part of the tax team, that's where that really comes into play, where we're actually running an actual tax return, not just kind of making up some numbers and, it's probably this. We're running an actual tax return when we do those tax projections to really make sure that you've got the most tax efficient retirement income strategy as you possibly can, because let's face it, you're only spending what you're getting to keep after the IRS takes its cut. So make sure you're kind of really thinking through that one in terms of where that cash flow is coming from, and to maximize out the tax efficiency, if you will, on that. I think we're up to number 3. Well, if you're planning on retiring early, you probably want to be maxing out your retirement contributions, particularly in those last few years of working. You really want to try and maximize those out. One of those couples we talked to just this past week really kind of devising a specific strategy that we were advocating to really maximize it out. And here's the thing, those maximum contribution levels have in fact gone up, and there's even a new one now for this year. So if you're over age 50, there's the ability to do a catch-up contribution into your employer plan, like a 401k, a 403b, or even a deferred comp 457, where you can contribute an extra $7,500 if you're over age 50. But there's also a new one that if you're 60 to 63, you can actually do 150% of that catch-up amount, allowing you to go all the way up to an extra $11,250. So that's a pretty nice additional contribution that's available to you that to really bulk up those savings in the last few years of work. And certainly that makes a lot of sense. Next up on our list of sort of boxes to check if you're planning to retire early, you've got to kind of spend some time figuring out this Social Security stuff. And obviously that's where, thinking of the office again, that's where Rob Field, who's our National Social Security Advisor, comes in and really helps to give folks a perspective on that Social Security. We're going to slide to the break, and when we come back, I want to kind of continue this conversation about these last couple boxes that you need to check, Social Security, and then there's one more to give you a little bit more strategy on trying to figure out how to retire early. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're working through some of the boxes that you need to make sure you're checking if you're thinking about retiring early. To recap where we are in this conversation, the first one is one that you hear talk a lot about here on the program, and that is make sure that you have a good understanding of your health insurance options along with your total cost of health care. This is always a biggie, and especially when you see the studies that say that the average 65-year-old is going to need about $165,000 of after-tax dollars to cover said expenses over the course of their lifetime. So if you're a couple, well, then you got to multiply that by 2. That's $330,000. That is a lot of money. And yes, you do get Medicare at 65, but if you're retiring early, then you got to figure out your health insurance some other way. And even then, at 65, as we said, there's not a perfect solution because Medicare does still cost. It's not totally free. Only Part A is free. And then the importance of understanding your cash flow. And there's different components to that. It starts with obviously looking at your investment allocation, which should have been shifting along the way as you're getting close to retirement. Talking about income, money in, money out. That's kind of the budget thing. We had, as we mentioned, we had a couple of conversations about this very topic this past week. One of the couples had a very good budget. So I said, kudos to them. And we went through it. We said, well, you probably want to budget a little bit more for travel and fun because you kind of do more of that when you're first retired. And then you may want to kind of kick it up a little bit on the budget item for your income taxes because, you're going to have to pay taxes on all this stuff. And then lastly, just making sure that you're getting that income that you're getting in retirement in the most tax efficient manner possible. That's one of the biggest reasons why we actually do tax returns at the office, is to accurately come up with exactly what that strategy is. Next up on the list, of course, Social Security. Can't forget about that. You've got some decisions to make in terms of Social Security. The reality is, it's a pretty wide age range where you could, in theory, take Social Security starting at 62 all the way up to 70. Full benefit typically for most people these days is 67, but it's a big swing, right? The thing you got to be careful about right out of the gate is that if you are still working, making any kind of earned income, then know that there is an earnings limit that applies until you get to full retirement age 67, that if you go over it, you have to start giving your Social Security back. So if you're planning on still working, even though you may be sort of retired, you got to be careful that you don't trip over that number. It's relatively low, $23,400 for the year, which means then that, you definitely got to check that number because that could impact your Social Security as well. As we mentioned, that's where we've got a team of experts at Nelson Financial Planning. That's where Rob Field specifically comes in. He's our resident national Social Security advisor, and I believe he's going to join me next week on the program. So he doesn't know that yet, but we're going to talk to him. No, we've got a schedule. It's all mapped out. So in terms of Social Security, the reality is that, starting at 62 is an option, but that is about 30% less than what you would get at your full retirement age at 67. If you wait till 70, you collect 24% more. So between that 62 and 70, it's like a 50% difference in the amount of monthly income that you're going to get. So you really got to kind of think that one through and make sure that what you're coming to the conclusion on makes sense for you in terms of the timing as to when to collect Social Security. And then lastly, and this ties in with what we were talking about earlier in the program, you got to get rid of that high interest credit card debt. That's just a non-starter. If you have a bunch on credit cards, don't even think about retirement. You got to get those tackled. And we would probably argue your best case retirement scenario is really not having any debt on the book. So if you can get that mortgage paid off before you retire, kudos to you. But the reality is, particularly on this unsecured debt, this credit card debt, if you got something costing you nearly 24%, that's not going to work. That's just going to really pull your income out and have it go to that debt service versus you being able to use that income for fun stuff in retirement. So there you have it, folks, sort of the 5 boxes that you need to be checking off if you're planning on retiring early. Again, if you're not sure of whether you can check off all these boxes, or maybe you've got questions on sort of one or two of them, then that's what we're here for, the entire team at Nelson Financial Planning. So check out our website at nelsonfinancialplanning.com and go ahead and schedule one of those free conversations. So next up, we're going to try and spend some time going through and hopefully demystifying the required minimum distribution and sort of what's involved in that. There's a lot of confusion over this and a lot of misconceptions. The required minimum distribution has been around a long time, and as a result, then, if anything that's been around a long time in Washington, chances are it's kind of changed a little bit over the years, and that in and of itself creates certainly a large amount of confusion about required minimum distributions. And then we want to kind of provide some of the background information, explain how to calculate it. People often kind of get tripped up here because it's division and, math, addition, subtraction, we all got that. But division can sometimes be a little tricky. And so how to calculate that, how to get to the number, who has to take it and when, and really how the rules have changed over the years. So that's kind of all of our topics on required minimum distribution. So let's get started, shall we? First, what is a required minimum distribution? So a required minimum distribution, often referred to as an RMD, or sometimes you see it as an MRD. It's the minimum amount. So minimum, right? Required minimum distribution. That should kind of give it away. It's the minimum amount that you must withdraw from your retirement accounts each year once you hit a certain age, right? So that kind of makes sense. The purpose, of course, of the required minimum distribution is that is the government sort of forcing you to utilize and to access and to withdraw dollars that have never been taxed. Remember, the RMD applies to sort of pre-tax retirement accounts. So that means all of those dollars plus all of that subsequent growth never been taxed at all. So the purpose of the required minimum distribution is then to force you, you've got to take some money out. And when you take money out, guess what? You got to report it on your taxes. And then correspondingly, you've got to pay taxes on that. So that applies to all types of retirement accounts, whether it's IRAs, whether it's 401ks, simples, all of those types of things. The only one it doesn't apply to is a Roth account, which is obviously after-tax money. And then in terms of the required minimum distribution, there's also an exception for the qualified retirement plan that is at your work if you are still working in past required minimum distribution age. So like employer plan, you're still working, the balance in that 401k you do not need to include in the calculation of your required minimum distribution. So a couple of exceptions between the Roth and that one that shifts around kind of what that required minimum distribution is designed to tackle in terms of requiring distributions out of those retirement accounts. We've got a lot more to talk about with this required minimum distribution stuff. We got to talk about some of the common issues. We got to how to calculate it, who must take it, and how those rules have changed over the years as we attempt to demystify a little bit the required minimum distribution rules that we see. So we are going to cover more of that when we return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So attempting to demystify the required minimum distributions on this week's episode of Dollars and Cents. Before the break, we were talking about the kind of the background, like what is the required minimum distribution. Now let's kind of go through some of the common issues and sort of the confusions that people have about required minimum distributions. Because one of the major points of confusion is sort of the age at which you have to start. And this one is simply, I think, often predicated on the fact that this requirement to take out a certain amount of money each and every year from your retirement accounts has in fact been on the books for many, many years. And the age, in recognition of kind of life expectancies getting longer, the age has shifted. So when it first started, the age where you had to start taking out a required minimum distribution was at 70 and a half. It moved to 72. Now it is age 73. But in the year 2033 and beyond, that age will actually increase to age 75. So that trajectory of the required minimum distribution age piece continues to sort of trickle up, and then it'll remain at 73 until the year 2032 or through 2032. And then in 2033, it actually goes up to 75. So know that age will continue to shift as well. It's no longer that 70 and a half thing. And eventually it'll no longer be 73 either. It'll be 75. Another question that we often get is, well, can I kick the can down the road? Do I need to take out my required minimum distribution? And there is an exception to that, but that exception only applies in year one of your required minimum distribution. So if it's your first year that your required minimum distribution is required, you do have the option where you could delay that required minimum distribution until the following year, but only for the first quarter of the following year, because you got to have it out before April 1. The other sort of caveat, if you're looking into doing that, is know then that year you're going to have to double up. You're going to have to take 2 required minimum distributions, because if you're delaying the first year's required minimum distribution to the next year, well, the next year also has its own required minimum distribution. So you effectively wind up sort of doubling up that amount. So it's rare to kind of see people take advantage of that, but there are certainly always some cases where that might make sense. So just be aware that is an option. Of course, to figure out your required minimum distribution, there is a calculation involved. You may want to get your calculator out for this one, though. Even though the calculation itself is somewhat straightforward, you just take the balance of your retirement account as of December 31 of the prior year, or you could also describe that as January 1, because January 1's a federal holiday, so the markets aren't open on that day. But take that number, and then you want to divide it by the life expectancy factor as provided by the good folks at the IRS. They've got specific tables for this, and also specific tables if there's more than a 10-year age gap between you and your spouse. There's a whole set of other tables that you would use to determine your life expectancy factor. But it's from there just a math division problem, if you will. So by example, let's say you're 78. Okay. And according to the IRS tables, your life expectancy factor is 22. Okay. So because it's the life expectancy factor in the year for the age that you will be turning that particular year. That's kind of how you kind of find it on the chart. What age am I turning here in the year 2025? That then is my respective life expectancy factor from those IRS tables. And then the math problem. So my balance at the beginning of the year and the prior year, same diff, $150,000, right? And okay, my factor was 22 because I'm 78. I'm not 78, but yeah, you get the idea. 22, so take the 150 divided by 22, and you get an amount that is roughly around $6,800. That's the important number to remember. Let's compare that, because here's where also part of the confusion, part of the concern comes into play is, if you've got $150,000 in a retirement account and you are 78, chances are you're retired. Chances are also that you're probably taking income off of that asset. And in fact, the vast majority of people who are retired sort of automatically wind up satisfying their required minimum distribution by virtue of the income that is coming out of their retirement accounts. Remember, a required minimum distribution is just that. It is a minimum amount that must come out. So if you're already taking money out, that'll count towards it. You don't have to do the minimum on top of what you're already taking taking out. And I think that's where, kind of the aha moment, if you will, comes in for a lot of folks when they realize, because you read this stuff on the internet and it's like, oh my goodness, you're going to have a required minimum distribution and you're going to owe so much in taxes and it's just going to be crazy and you're going to have to go out on the street because you got to owe all this money to the IRS. It's 4.5% at age 78. I mean, it trickles up a little bit. It starts out when you first have to take it. It starts out at like 3.65%. At 78, okay, fine, it's trickled up to 4.5%. But for the most part, if you take an income from your retirement account, you've probably taken roughly that same amount anyway. So your required minimum distribution is in fact satisfied. Studies say that that's true for about 80+% of Americans. So don't let the required minimum distribution scare you into doing something that may not make sense, because oftentimes you hear this argument online where if you want to avoid the required minimum distribution, convert your IRAs all over to a Roth and then life will be grand and there'll be sunshine and birds and rainbows and all of those kinds of things. The problem is that you got to pay taxes when you do that. And we actually had a situation where an individual came in who had seen that message on their social channels, on Instagram, I guess, or whatever the heck it was, and was like, I converted all of my IRA to a Roth because then I can get all of those dollars tax-free. It's at that point we then had to explain to him, but you still got to pay the taxes on the conversion amount. I mean, the look on their face was just kind of sad, because now they're owing a ton of money on taxes because they just did what the internet told them to do, but they didn't realize that it was taxable. This fear over the required minimum distribution is very pervasive, and it is misguided once you actually have an understanding of what that calculation is. So make sure you understand how to calculate that required minimum distribution. Of course, who must take the required minimum distribution? Well, that's anybody with a retirement account. The exceptions, as we mentioned earlier, Roth IRAs, and you don't have a required minimum distribution requirement if you're still working and contributing and participating in an employer retirement plan. The rules have certainly changed on this stuff over the years. Perhaps the biggest rule change is what the Secure Act did a few years ago in terms of forcing 10-year payouts when people inherit retirement accounts. So just be aware, if you're inheriting a retirement account, you no longer get to stretch that out over the course of the rest of your life. You, in fact, are on a 10-year clock where that money's got to come out. Back to the concept of a required minimum distribution. Required minimum distribution is imposed because the government wants you to ultimately use those dollars that were put away on a pre-tax basis. So those dollars and all the subsequent growth never been taxed. Well, the U.S. government would like to tax this, hence these required minimum distribution rules, which apply in spades if you inherit a retirement account, because that's when you're on the 10-year schedule. So just be aware of that has changed quite dramatically. And then, of course, if you don't take the required minimum distribution, there's some steep penalties. It used to be that it was 50% of what you took out. The good news is that penalty's gone down to 25%. And in fact, if you correct a missed required minimum distribution within a 2-year period of time, that penalty further reduced down to about 10%. So important to certainly understand the required minimum distribution, not nearly as scary or dramatic as it's often described to be, because for most people, if they're taking normal income out of their retirement accounts, you're probably already satisfying your required minimum distribution. But if you don't, that's a pretty steep penalty even now. Who wants to pay an extra penalty on top of the taxes that you'd have to pay? Anyway, RMD is certainly an essential part of retirement planning. If you've got questions about those or anything else as it relates to your finances, don't hesitate to reach out to us at Nelson Financial Planning by going to our website at nelsonfinancialplanning.com. This has been Joel Garris of Nelson Financial Planning, and you've been listening to Dollars and Cents. Have a great rest of the day.